Accounts 212 students. We are back with groups again. We are looking at our 5th lecture and we are focusing on chapter 6. So once again, these slides are available on Moodle for your pursuit, so you can follow along with that. And we're going to switch over to the slides now. Okay, let's have a look at our lecture structure. Yes, so a reminder, we have 6 videos that we're having a look at for groups. You should have already watched videos 1 through to 4. A recap, video 1 was on the theory with regards to a group. So when do we have control? Video 2, we had a look at the statement of financial position, the wholly owned subsidiary, how we would do that consolidation. Video 3, we introduced if we have a partly owned subsidiary, so we had non-controlling interest, and how that would factor into our statement of financial position. And then the last video that you should have watched, which would have been video 4, still focused on the statement of financial position, but had a look at what would have happened after acquisition. So there was a passage of time, and we were no longer just looking at on acquisition dates, and that was chapter 5. And so this video, we're going to be having a look at chapter 6 of our prescribed text, and we are going to be having a look at other financial statements. We've been having a look at the statement of financial position up till now. So now we're going to have a look at our statement of profit or loss and other comprehensive income. And we're also going to introduce our statement of changes in equity. And we're going to have a look at all 3 statements and how they interact with each other. Okay, so we are looking at our chapter 6 of notes to group financial statements by Keith Prinsloo and Derek Forsyth. We're going to be covering the entire chapter. So within the chapter, we're going to be discussing 2 key things. The first thing is what happens to our retained earnings. So we did discuss in chapter 5 what happens with our retained earnings and how it now impacts the fact that we've got an income statement portion. And then we're going to discuss how it works with our other reserves. Okay, so the first couple of slides that we're going to have a look at is going to be with regards to our retained earnings. We'll then go and have a look at an example on that so that we can get some practical experience. And then we will turn over and go back to the slides, have a look at our changes in reserves. We'll discuss the theory behind it, and then there's quite a few examples thereafter to have a look at. Okay, so as a recap, we've only looked at the statement of financial position. And you should know from your individual companies how the statement of financial position is linked to a statement of changes in equity and is linked to a income statement or statement of profit or loss and other comprehensive income, or it's also referred to statement of comprehensive income. Okay, so I'll generally just be referring to it as an income statement because we're only going to be looking at the profit or loss section. Okay, so a reminder, our retained earnings is actually equal to our opening balance for the year plus our profits less our dividends. And our profits is calculated in that income statement portion. Yeah, so in our income statement portion of our statement of profit or loss and other comprehensive income, we end off with profit after tax. That profit after tax would then filter into our statement of changes in equity and will increase our retained earnings if we've made a profit, decrease it if we've made a loss. And we show that in our statement of changes in equity. Our statement of changes in equity will have our columns of our share capital, our retained earnings, and any other reserves. It will have totals in it, and those will filter back into our statement of financial position and be equal to our equity section. Yeah, so from a financial reporting perspective, you should be familiar with interlinkings of the financial statements. Yeah, when we're looking at the consolidated financial statements, those interlinkings are exactly the same. Okay, we will still have an income statement portion. It will still be linked to our statement of changes in equity, and it will still be linked to our statement of financial position. Okay, so what is the process that we'll follow? So we're now taking chapter 5, which discussed the retained earnings and the since retained earnings, and we're going to expand it because of the fact that we understand that within that period, after we have acquired our subsidiary, we have a current year, and the current year has got a statement of profit or loss, and therefore we are going to be creating a consolidated statement of profit or loss, and that will filter through into our statement of financial position and filter into our statement of changes in equity. And so because of that, we now actually need to divide that since acquisition retained earnings. If we go back to example 5.1, we divided that 30,000 and we divided it into 21,000 that remained as since retained earnings for our holding company, and the 9,000, which we did a pro forma journal entry for, to remove it and put it into NCR. So now what we're saying is, of that 9,000, a portion of that is actually attributable to the current year, and a portion is prior years. So we need to do two separate pro forma journal entries for it. Okay, so this slide here might look very complicated, and again, it is just a summary of what we are doing. If you're not understanding from this slide how it works, when we go through the example and we add our numbers to it and we discuss the example, this slide then should make a little bit more sense. Okay, so remember, when we acquire a subsidiary, it has got a retained earnings. On this slide, this is referred to as the at acquisition retained earnings. That retained earnings is eliminated through the fact that we have an investment and we created our non-controlling interest. From that time, our subsidiary continues to operate. So our since acquisition profits that we are going to adjust for are now the difference between the retained earnings at the beginning of the year, because we have an income statement. Okay, so with the retained earnings at the beginning of the year, minus that at acquisition retained earnings, and that's going to give us our since or post acquisition increase or decrease in retained earnings. Those will affect our opening balances and our statement of changes in equity. Yeah, so when we look at example, we're going to look at example 6.1. We are going to see that we had an opening balance in our statement of changes in equity, and that is how we have calculated it. So our opening balance in our statement of changes in equity is going to be similar to the process that we followed in chapter 5. And in order to create that NCR portion, we will still be doing that debit retained earnings and credit non-controlling interest. Okay, the big difference between chapter 5 and chapter 6 is that we are now going to be having a look at that retained earnings at the beginning of the year, because of the fact that chapter 6 introduces the fact that we have a statement of changes in equity, which shows beginning down to the end, and we also have a statement of comprehensive income. Okay, what about the current year increase then? What are we going to do with the current year increase? So for the current year increase, we are going to now have a statement of profit or loss and other comprehensive income. And that is going to calculate our profit or loss. Okay, our consolidated profit or loss. That consolidated profit or loss is then going to be divided on the face of our statements into two parts. We are going to tell our users what is attributable to the equity holders of our parents. Okay, and there's the calculation that you would be following. So it's equal to the parent profit plus whatever their share of the subsidiary profit is. And what is attributable to our non-controlling interest? That is our subsidiary's profit multiplied by our non-controlling interest portion. So now our previous journal entry, pro forma journal entry that we had a look on the previous slide, that is to account for since acquisition earnings up to this year. Now we need to account for our earnings for this year. So this journal entry that we have on this slide, the debit non-controlling interest share of profits and credit non-controlling interest, is the journal entry for the current year profits. Okay, so it's expanding upon our chapter 5 information. Yeah, so we're going to turn into our textbook to page 62. We're going to have a look at example 6.1. We're going to go through that, and then we will come back to the slides and we will discuss what happens with our reserves. And we will then have a look at examples that combine both this process as well as the reserve process. Right, so here we are on example 6.1. Okay, let's read through the question. H acquired 70% shares in S on the 1st of January for 160,000. At that date, H considered all the net identifiable assets with the exception of land to be fairly valued. Okay, so land is 50,000 more. And then you can see we are given the equity on the 1st of January 06. Okay, so let's dissect this information quickly. Okay, if we acquired 70%, that means our NCI is 30%. That 1st of January 06, that is our acquisition date. So we need to start our consolidation. Okay, our 160, that is our investment amount, was 160. Okay, remember that was to acquire 70%. Okay, which we're going to take into account when we are doing our pro forma journal entries. Okay, the fact that the land is worth 50,000 more, so we have a 50,000 fair value adjustment that we need to make. Okay, and that's going to affect our net identifiable assets of S on acquisition. Okay, and then we have been given what our share capital, other reserves, and retained earnings are. We need this information because we need to know what our net identifiable assets on acquisition are. Okay, and this is so that we can do our on acquisition pro forma. Journal entry. Okay, then unlike what we saw in our previous examples, we have now been given a trial balance. Okay, so you would have to go through the trial balance and see. Before, we just got given a statement of financial position because we were only dealing with the statement of financial position. Now we have been given a trial balance, or we might get given both statements, so the statement of comprehensive income as well as the statement of financial position. Okay, so because it's a trial balance, we need to go through and we need to ask ourselves, is it a statement of financial position accounts or does it affect our income statement? Okay, so if you go through each of these using your knowledge from your standard accounting processes, you should be able to identify what belongs in the income statement and what belongs in the statement of financial position. Okay, before we have a look at that, you'll notice, yes, in here we do have our investment in S. Okay, here's it over here. Investment in S. Okay, so although we got given the 160 at the top, we could have found it in our trial balance as well. And we can also see here that we've got share capital for S105, so our share capital has not changed. It was 105. Remember, for accounts 212 purposes, this will not change. Okay, so we're not going to be having a look at the increase in share capital. Now, our other reserves in this example was 15 and 15, so we've had no change. This example does not deal with the change in other reserves. The subsequent examples will deal with that once we've gone to go and have a look at the slides. And then very importantly here, we can see our retained earnings is 30. It's now 55. Okay, but an extremely important portion is that this is only on 1 Jan 09. Our trial balance is at 31 December 09. So we should therefore be able to see, without going through absolutely every single account in here, that that means that that retained earnings is an opening balance. Okay, so let's make a note there. That's opening balance. Okay, so that 55,000 is our opening balance. It does not include current year profits. So therefore, we need to calculate current year profits. Okay, if we were given a trial balance and that date was silent, we could assume that it was at the end of the year. But we can also see that there are income statement accounts. So we can see there's sales, there's purchases, we've got depreciations. So all those different accounts are important to see. The income statement accounts, we would have to then draw up an income statement to calculate what the current year profit is. Okay, so that will be done via an income statement. Okay, or our statement of comprehensive income. Okay, we also have inventory on 1 Jan 09, and we have purchases. So you should be able to see that we therefore are using the periodic system. Yeah, we do not have a cost of sales. We've got purchases and opening inventory, and then we got given closing inventory. So we're going to have to calculate cost of sales. Okay, it's important to understand our plant was used in the manufacture of inventory because it will also affect our cost of sales amount. So let's just have a look through the rest of the accounts here. We have share capital, other reserves, retained earnings. Those all affect our statement of financial position. Our sales, our purchases, and our opening inventory, as well as administration expenses, depreciation, rent and leasing, and other expenses, those should all affect our income statement. Accounts receivable, accounts payable, and bank, those will all be with respect to our statement of financial position. Taxation expense, that would affect our income statements because we finish off with profit before tax, deduct tax to get profit after tax. Land at cost, plant, the cost and the accumulated depreciation. Yeah, and then we have our investments. Those all affect the statement of financial position. Okay, note that in terms of S, this plant only belongs to H. There is no plant over there. Okay, it's all 0. So that means we will not have to worry about taking out our at acquisition accumulated depreciation. We don't have to figure out what our at acquisition accumulated depreciation is because S does not have any depreciation. Okay, so taking all this information into account, let's now then go and perform our consolidation. Okay, so to perform our consolidation, we need to be able to do our pro forma journal entries, because you can just be asked to do pro forma journal entries as well. So where do we start? We start on acquisition date. On acquisition date, we first of all go and remove our S's share capital and other reserves, any equity. Okay, we create our fair value adjustments that we have highlighted here, that 50,000. We will create our NCI and eliminate our investments. Okay, that will be our first journal entry, our at acquisition journal entry. We will then have to account for the since retained earnings up until the beginning of the year. Okay, so we can see that it's still highlighted. It's 55,000, whereas when we started the consolidation, our retained earnings was 30, so we've made another 25,000 profits. We need to divide that into what belongs to our NCI and what belongs to us, and do the journal entry for the non-controlling interest. Okay, so the non-controlling interest will be 30% of that increase. We then have to go and calculate our profits. We need to know what profit or loss is made this year, so we can go and allocate that profits through to portion to our NCI and a portion to our holding company. So let's move down and have a look at that consolidation. Okay, so a starting point, we need to know what the current year profit is. So what they have done here is they have calculated the sales was given to us. They have calculated the cost of sales based on our opening balance of inventory given to us, our closing balance inventory given to us, and our purchases. The depreciation obviously would be included, okay, in that, because of the fact that they're used for manufacture. And we've done that for H and S. Okay, we've then said to ourselves, we purchased 70% on the 1st of January 06. We are now on the 31st of December 09. Okay, so we need to now understand what happened between 06 and the beginning of our financial year, which would have been the 1st of January 09 or the 31st of December 08, and then go through and have a look what happened between that for the current year. In our analysis of equity, that first line there is our on acquisition dates. Okay, so that's calculating our goodwill, etc. This portion here is my since earnings up till the beginning of the current year. And then this portion over here is analyzing our current year. Okay, so that's current year, in other words, our statement of comprehensive income. Okay, so if you're comfortable to be doing the analysis of equity worksheet, we have discussed it in the previous examples. You can then analyze S's equity accordingly, and you would easily be able to then identify the 25 from the increase from 30 to 55, and then the profit, which we have then identified over here by calculating the profit through working one. Okay, that will also make it easier for you in terms of all being able to divide it between your NCI and your parents. Okay, remember your parent is equal to what you have in H plus whatever you've earned in S since. Okay, so it's plus this since retained earnings, because you have earned that due to the fact that you have control. Okay, so here's our consolidated statement of profit or loss and other comprehensive income. At this point for chapter 6, It is merely an H plus S exercise. Okay, remember when we are consolidating, we are adding our holding company to our subsidiary, and then we are accounting for non-controlling interests, okay, through our adjustments. So in our income statement portion, at this point, there are no things in our income statement that we need to eliminate. So all of our profits, so if we have a look, the 48 plus the 47 should equal to that 95. All of those profits are the consolidated profits. However, not all of that 95 belongs to the equity holders of the parents, okay, which is our H shareholders. H only has 48, which was their profits, plus their 70% share of this 47. Okay, so this portion here, this 8,900, is equal to the 48 plus 70% of the 47. The non-controlling interests are equal to our 47 times the 30%, because our non-controlling interests are with respect to our subsidiary. They only own a small portion of the subsidiary, the 30%. So we can only take a portion of the subsidiary's account. Okay, note you can very well do this calculation here. And then for the equity holders of the parents, then say that therefore this is the balancing. Okay, because our NCR portion and our parents portion must equal total profits. Okay, so you can see here, there's 95 and there's 95. Okay, so all that we have done is we have said this is our consolidated profit. It's 95,000. Okay, that 95,000 we're dividing, we are showing 95,000 is the total consolidated profits. It is being divided between our parent equity holders, so that is equal to our H profits plus their portion of our subsidiary, and then our non-controlling interest is their portion of the subsidiary. Okay, our consolidated statement of changes in equity now, what I want you to notice is this portion up to here, okay, where I've drawn that orange line. That portion is H's portion. Okay, so that's H shareholders. So our statements of changes in equity look slightly different to your normal statement of changes in equity that you would see for an individual, because we now have to consolidate. And when we consolidate, we are saying we have two sets of shareholders. We have H's shareholders, and then we have that non-controlling interest portion. So yes, our total equity, if we add our H plus S together, is equal to 980,000 on the 31st of December 2009. However, some of that belongs to H and some of that belongs to our NCR. Okay, so these opening balances, okay, that's 550 is only H's. Those other reserves are only H's. And because we have reversed our S out in our first initial at acquisition journal entry. The retained earnings, you can see if you go and have a look at our trial balance, so you can page back to your trial balance, you will notice that the retained earnings of H was 180. Okay, but we are showing 197,500 in there because of the fact that we have some since retained earnings. Okay, for our subsidiary. So that was we did that calculation. We said it was 30 on acquisition. At the beginning of the year, it was 55,000, so it was 25,000 profits, multiplied by the 70% that belongs to H, and then the 25,000 multiplied by the 30% went into our non-controlling interest. Okay, this non-controlling interest portion over here, that we did discuss through our analysis of equity. Yeah, so if you go and have a look at your analysis of equity, you would see that that column is actually exactly the same. So it is quite nice to be able to do the analysis of equity as a working, because then it filters through. Please remember to reference your workings, so that your marker will be able to see that you have taken this column from your analysis of equity column. Okay, your analysis of equity took your total equity of S and divided it into the since of H and the non-controlling interest. So that's 67,500 is our initial non-controlling interest that we recognized, plus any retained earnings that we had earned since. This line item over here, our comprehensive income, is method. Okay, so what do we mean by method? It comes from the statement of comprehensive income. So at the bottom of the statement of comprehensive income that we just had a look at, and you can turn back up there, we saw that we had total profits of 95,000, and we divided it into what was NCI portion share, which was that 14,100, and what was attributable to H's shareholders, which was that 8,900. Okay, we then can do a total, and you will notice if you have a look at this total column and we scroll down and have a look in our equity and liability section, we can't see the entire section on the screen at the moment, but we will see just now that it is equal to that statement of changes in equity. Yeah, so we can see the link that is coming through. We've calculated our profits. Our profits have filtered into our statement of changes in equity for the year. Our statement of changes in equity is equal to what we see in our financial statement. So our consolidated statement of financial position, we can see that what we have done is we have gone H plus S. Okay, this goodwill, we would have calculated through our pro forma journal entry. Alternatively, if we didn't need to do pro forma journal entries, we could just use the analysis of equity and have calculated from there. Okay, everything else here is H plus S. This equity over here, 898,400, you can see there's 898,400. 278,400, there's 278,400 up here, and the 70 and the 550. And so all of that is from our statement of changes in equity. So once again, this here would be a method taking from the statement of changes in equity. Yeah, so if you're asked to do all your financial statements, then you will get method marks. If you're only asked to do your statement of financial position, you can either choose to do a statement of changes in equity as you're working and then reference it across, so that you can get part marks. Alternatively, then you can do the calculation like what you can see here. They've done a calculation in the block there. Okay, that retained earnings is what was H's retained earnings, opening balance, what was H's profits for the year, what is H's since retained earnings up until the end of the year. Okay, the same for the non-controlling interest. This non-controlling interest, you can either go through and calculate it through your statement of changes in equity. You can do an analysis of equity worksheet. You can do your pro forma journal entries, but remember, non-controlling interest affects quite a few of our pro forma journal entries. It will affect our at acquisition one, where we have figured out how much to initially recognize it at. It will affect our profits for the year. It will affect our since retained earnings. It might even affect some of our transactions when we're having a look at our chapter 7. So when it comes to doing these calculations, it's not very easy to then just do it according to the pro forma journal entries, unless you have been required to go and do the pro forma journal entries themselves. And then you can reference back to those pro forma journal entries. But if you're only asked to do the consolidation, you need to think to yourself, there are so many different ways to get to these answers. There's so many different workings. Okay, there's the analysis of equity worksheet. We can use the pro forma journal entries. So depending on the scenario that's given to you, if you're asked to do pro forma journal entries, don't go and reinvent the wheel and then go do another working for something else. Use your workings for the same things that you need. So use your analysis of equity to be able to put the numbers in your pro forma journal entries and to be able to put it into your consolidated statement of financial position, because you want to use your time effectively. Then looking at the pro forma journal entries, we have discussed these already. This is our at acquisition. So by now you should be familiar with this. It's our at acquisition, share capital, other reserves, and retained earnings. Okay, that's why we can see the 30,000 here, not the 55. Okay, because this is at acquisition. It's on 1 January 06. Okay, we've recognized our non-controlling interest. If the question is silent like it was as to how to value non-controlling interest, please assume that it's at their portion of net identifiable assets. Okay, remember, it can be fair value, but then you need to get given the fair value. Okay, and then we would have done our balancing to have arrived at that 20,000. Our second journal entry here is our since retained earnings to NCI. That's at the beginning of the year. Okay, because we now have got an income statement, so we're only going to do it up to the beginning of the year. And this journal entry is then our NCI portion of profits. Okay, all of which we have discussed the calculations in the workings above. Okay, all we have discussed it in detail in the previous examples, and you need to just go and make sure that you can do those calculations. Then lastly, it does a consolidation worksheet. If you're comfortable doing this by saying, well, this is my holding company, this is my subsidiary, these are my adjustments according to my pro forma journal entries at the top there that I'm going to be making. So what is my consolidation portion? Okay, if you're comfortable doing it this way, you can do your workings this way as well. Okay, and then lastly, it shows you the end product method. Okay, all of which will filter into each other. Okay, let's go back into our slides. We're going to then have a look at our post-acquisition increases in reserves. So what happens if any other reserves that are in our financial statements increase? So we've looked at retained earnings. Now, if we have another reserve account, it could be called other reserve, could be an asset replacement reserve. It can have any name. Just we're looking at any reserve other than our retained earnings. What happens if they increase after we have acquired? And also what happens if we do a transfer in the year? Yeah, so generally when we have a reserve, it's a special reserve for something. So let's talk about an asset replacement reserve. We are keeping aside a portion of our retained earnings specifically so that we can replace our assets. Yeah, so we keep a special reserve for that. Every year we will probably take a portion of our retained earnings and put it into that reserve, because that is the reserve that we're keeping specifically for assets. Remember, our retained earnings is our come all be all reserve, whereas the other reserves that we have are specific for different purposes. Okay, so let's go back to our slides. Okay, looking at our post-acquisition increase in other reserves, once again, we will have to have a look at what was our reserve when we purchased our share of our subsidiary and compare it to the reserve that we have at the beginning of the year. So in example 6.1, that was exactly the same, so we didn't need to do any adjustments. However, if there have been movements, we would need to have an adjustment, and we would then need to therefore account for the NCI portion of that change in reserve. Yeah, so it follows the exact same principle as retained earnings. However, we're just looking at an other reserve. Okay, with regards to the movement in the current year, so that would be a transfer from our retained earnings into the reserve. Okay, so if we are looking at our NCI portion, we will not account for an NCI portion because our NCI is showing all equity that belongs to our non-controlling interest. So effectively, if we were to be doing a portion for NCI, we would be showing it coming in NCI and going out NCI if we were to show it in our financial statements. Okay, which doesn't make sense to take it in and put it out. Okay, the parent portion of the reserve, we need to make sure that we account for that parent portion and that we show that parent portion in their reserves. And so it is similar to the income statement where we had to divide it between the NCI portion and the parent, but because it is now a transfer between our equity, for NCI we won't be showing a movement, but for our parent we will. Okay, so the examples there are quite a few examples that we're going to have a look at. We're not going to have a look at every single detail in all these examples. I will highlight a few things. You will need to then go through them on your own. Make sure that you are able to do the things that we've learned from the previous examples. Okay, so with regards to the retained earnings, with regards to the NCI portion, okay, all those kinds of journal entries. We've done quite a few examples on those, so we're not going to be focusing on that. We are going to focus in these examples on what happens to our reserve. Okay, so let's turn back into our textbook to example 6.2, and we will then progressively go through these examples to have a look at what happens with the reserve. Okay, here we are in example 6.2. We're working with 70% holding again, so we have 30% NCI. We have an acquisition of 1 January 6, 160. Okay, the land was 50,000 more again. And we can see we have an asset replacement reserve, and that asset replacement reserve was 15. okay, on acquisition. Go down into our trial balance that has been given to us. Our asset replacement reserve is now 60. It's changed from 15 to 60. So there has been an increase. We need to be able to account for that increase. Okay, that is at the 31st of December 09. So we'd have to then go and read to see, has there been a transfer during the current year from retained earnings to the asset replacement reserve, or has there not? Okay, so like I said, I'm not going to be focusing on the at acquisition journal. You should be able to do that. We can see the investment, we can see that we've had a fair value adjustment. We know how to calculate our non-controlling interest from that, and we know we need to eliminate our at acquisition net identifiable assets, which was given to us here in this little square here. Okay, so we know we need to be able to do that. I'm not going to be going through that. I'm focusing on the analysis of equity and what we are going to be doing with our reserves. So let's go down into the trial balance. We can see in our trial balance, the trial balance has stated that there is a transfer to the asset replacement reserve that happened during the current year of 10,000. Okay, so there has been a transfer that's taken place to arrive at that 60,000. Okay, we can see we have been given profit before tax and tax expense. So obviously this company, they have already gone through and calculated a lot of the profits, and they've just condensed the information for you now. Okay, so we can calculate what our profit after tax is by using that, and we would then be able to do the journal entry with regards to current year profit. So let's draw our attention to our asset replacement reserve, because that is what we're going to be having a look at in our analysis of equity, and that's what we're focusing on. Okay, so our analysis of equity begins on the 1st of January 06 when we purchased the controlling share. Okay, and we've performed the analysis of equity on that day. We were given that it was 105 share capital, 15 reserve, 30 retained earnings. Okay, in our trial balance, we were told that we had 55,000 retained earnings. We were given our profits. Okay, we got given profit before tax, and we got given tax, so we could calculate that profit, that 47. We were given the fact that we had a transfer of 10. Okay, that was in our trial balance. We were given this closing balance of 60. Okay, so we can therefore then work backwards with the things that we were not given. So I would encourage you, go redo this. Look at what you've been given in your trial balance, okay, or if you've been given statements, go and have a look at what's in your statements, and then go and be able to work backwards so that you can see that from January 06 to December 08, our asset replacement reserve increased by 35. So that is a since acquisition increase in our equity. It's not since retained earnings, it's since on a reserve. So we need to have a separate column accounting for our reserve. Okay, in this example, our holding company also has an asset replacement reserve. So we can add our since to our asset replacement reserve. If the holding company did not, we could just put a new column for asset replacement reserve, and we'll just have the since portion in there. So that 35,000 increase there has been divided between NCR, okay, which would have been included in this 18 here, and our holding company. That 25 increase in retained earnings has been divided between NCR, okay, over there, and our since retained earnings. Okay, so this 18 is NCR's portion of both the asset replacement reserve and the retained earnings. Okay, notice the transfer. we have a 0 under NCI because I said, remember, it's coming out of retained earnings and going into asset replacement reserve. Our NCI is significant of all equity. So if we wanted to show that 3 that is attributable to NCI, we're going to be showing +3 -3 in the same column. And that's how we get to that 0. So the transfer does not actually affect our non-controlling interest column. And our since retained earnings, we can see 7 has gone through the 70% into our asset replacement reserve from our since retained earnings. Okay, so once again, we have done our consolidation. We've arrived at our profits, okay, using H plus S. We have divided our profit, there's our profit there, into our holding company and our non-controlling interest, like we did for the previous example. We have then now got a new column in our statement of changes in equity, which is our asset replacement reserve. Okay, that asset replacement reserve is going to be equal here to whatever H's asset replacement reserve was, okay, which was the 88 minus the 18, okay, because there was an 18 transfer for H. Okay, there's the 18 transfer, plus whatever is attributable to us from S. Okay, so those ones that I've highlighted there in orange, those are H's. Let's use a new color. That's very different. So let's use green. That 24,500 and that's 7,000. It should not be, that 4 should not be there. Please remove it. This is a typo. Okay, so that 24,500 and that 7, those are S's. And it's H's share of S's. So our 70% share. Okay, the same for column 2. The 17,500 minus that 5 should not be there. That is our portion from S. That 180 was H's. So you can see we are still saying H, but H not only has what they control, they also have what is attributable from their holding in S. Okay, this non-controlling interest column over here that we see, okay, that is easily gotten from our analysis of equity. Okay, however, we can calculate it manually. That 14,100 has come from our income statement, and this 78,000 here would be our opening non-controlling interest plus any movement from our reserves, retained earnings and asset replacement reserve that are attributable to our non-controlling interest. That's how we would have arrived at that 78. Okay, moving down, again in our consolidated statement of financial position, we can see that we have got our holding company, our H, plus our S. Okay, and then we have made our adjustments. Okay, these checks over here, again, it's our holding company plus the holding company share of S. Okay, and this, it says other reserves there, but it should read asset replacement reserve. Okay, and again with our retained earnings, it's our holding company opening plus our holding company profits. Okay, this 89 and 41 is holding company profits because it was profit before tax, minus our holding company transfer, okay, to our reserve, plus S's portion of retained earnings at the end of the year. Okay, our pro forma journal entries have now expanded. This first journal entry you should be able to do with your eyes closed by now. Okay, our at acquisition. You can see we now have, with regards to our since, this is our since reserve. This here is our since retained earnings. This one here is our current year movements in terms of profits for NCI. And this here is our current year transfer with regards to NCI. Okay, because on our financial statements, when we are having a look at our H portion for our asset replacement transfer, it was 10. We're only showing 7 because 3 belongs to NCI. So although on our analysis of equity, I've said that we do not process any of these adjustments in there, and we saw that 0 because it would be a +3 -3. In terms of our pro forma journal entries, we have shown a full transfer in S of 10,000, whereas on our financial statements for our consolidation, we are only showing S's transfer at 7 because that's our holding company share. Okay, so we would still be doing a pro forma journal entry for it, even though it does not affect the NCI. Because you can see here, there's no NCI account. Okay, it is affecting the transfer to asset replacement reserve. It's not affecting the NCI account. Okay, and then the end product method, you can go and have a look through, but we have explained where these things come from. Okay, example 6.3 has got all the exact same information in 6.2, except for the fact that the recoverable amount of goodwill has been calculated as follows. Okay, so the recoverable amount of goodwill on the 31st of December 08 is 16, and the 31st of December 09 was 10. Okay, so let's go back up here quickly. It's the same information, so we would have initially calculated goodwill at 20. Okay, that was on the 1st of January 06. We would have recognized the 20. Now we are being told that it's worth 16 and then it goes down to 10. So we must know that therefore that goodwill has been impaired downwards by 4 and has been impaired further downwards this year by another 6. So we now also need to understand, who is this goodwill attributable to? That's correct. It is all attributable to H, because of the fact that we have not recognized our NCI at fair value. Our NCI is at their share of net identifiable assets. Okay, so the change that's coming in now is that we will see our goodwill is being changed. It has been written off there of 4 and 6. That adjustment is only attributable to our holding company shareholders. So we can see in our statement of profit or loss, we have written off 6 during this current year. So we have an additional 6 that has been removed. And that full 6 affects our equity holders of parents. So if we compare, before we had 95 profit here, and the 95 was being split 14,100 to 8,900. Now when we're splitting it, our holders of parent are only getting 74,900 because that 6 has been written off of their share. Okay, go down and have a look. Our asset replacement reserves, all that sort of thing is exactly the same. Okay, so you can go and redo your calculations here. The change that has happened is because of the fact that we had that 6 write-off. It affected our current year profits, so therefore it would have affected our current year retained earnings. Okay, then we will also see our goodwill in our financial statements, okay, which was included under non-current assets, is not shown as 20 anymore. It is now shown as 10. Okay, and then we will see now, in terms of our pro forma journal entry, because goodwill did not exist in our normal financial statements, it only exists in our consolidation and was created upon this consolidation entry. that 20 would still be our at acquisition journal. But we will be writing off that goodwill every year. Okay, so because it went down to 16, here's our first goodwill write-off over here. Okay, so this is write-off of goodwill. And that was for the prior year. So note that it has affected our retained earnings balance because of the fact that it's with regards to the prior year. So it would have gone through our prior year profit or loss, which has gone into our retained earnings. And then this is our current year goodwill write-off of the 6,000. Okay, note that is going through our profit before tax as a goodwill impairment. Okay, because of the fact that it's our current year adjustment. Okay, so that is the difference that I want to highlight in this example. All the other calculations are exactly the same. I'll transfer to asset replacement reserves. The principle of what happened when we divided our share of profits is exactly the same. Okay, the difference being the calculation did change because of the fact that we had the 6,000 write-off. Okay, example 6.4 says assume the same information in example 6.2, except for the fact that accounts receivable and the investment has changed. Okay, so the investment went down to 130. So if we have a look at our analysis of equity, we can see we no longer have 160. We have an investment of 130. So therefore, we have a negative goodwill, which would have gone through to our retained earnings, which we discussed in an example in chapter 4. So go back, do those calculations. We have a look at how you would be transferring from your retained earnings into your reserve. What about your since acquisition reserves? What about your since acquisition retained earnings? What about your current year profits? Okay, all that is exactly the same in this example. I'm highlighting the difference, and that is that now our investment has changed, the 130. So we now have a gain on bargain purchase. So therefore it goes through into our retained earnings. So you see our profit is back to 95 now. Okay, because we don't have any impairment of goodwill because there is no goodwill, it's negative goodwill. Okay, our concept of our statement of changes in equity is exactly the same. Our concept of our statement of financial position is exactly the same. Note when we have a look at our pro forma journal entries, we have now got a gain on bargain purchase, which goes through to retained earnings at 10. Okay, that is all that has changed in this example because of the fact that our investment changed. Okay, because our investment changed, it was an asset that changed and went down. That is why they had to change another asset, which they chose to be the accounts receivable. Okay, let's have a look at example 6.5. Okay, example 6.5, we have acquired now 60%, so we have a 40% NCI. And we acquired them on the 31st of December 02 for 65. Okay, so we've got an investment of 65. Okay, there's our investment of 65 once again. Retained earnings and asset replacement reserves were 10 and 20. Okay, on acquisition, we can now see we have a retained earning here of 10, and we have an asset replacement reserve of 23. Okay, we do have, there's tax, we do have a transfer, we do have a dividend. Okay, which is important because that would have affected our retained earnings. Okay, and we do have profit before tax. Okay, so that indicates to me that that retained earnings of 10 is as at the beginning of the year, and we therefore still need to calculate our profits. Okay, at the date of acquisition, all separately identifiable assets of S were considered to be fairly valued with the exception of land, which was 20,000 more. Okay, and S did not revalue the land in its own books. That's important to note because that means that when we have a look at our land here, when we see land and buildings at cost, we know that they have not been revalued, so we still need to account for that 20. Okay, let's move down. Okay, so we asked to prepare the consolidated statement of profit or loss. I'm first going to have a look at our pro forma journal entries, and then I'm going to come up and have a look at our analysis of equity. Okay, so our first pro forma journal entry that we need to consider is our at acquisition. Okay, so we need to know what was our investment, okay, which was 65,000. We need to know what was our net identifiable assets. In this case, it was retained earnings of 10,000. It was asset replacement reserve of 20,000. And it was a land of 20,000 as well. Okay, we also need to have NCR. Now we're just going to move this one across a bit because that's a credit. These are debits. Okay, NCR is going to be at their portion. So we have 20,000, 20,000, and 10,000. That's 50,000. Okay, times by our 40%. Okay, so that would be 20,000. Okay, sorry, I haven't included our share capital in here yet. Okay, share capital was 50,000 as well. So our non-controlling interest is actually 100 times 40%, which will be 40,000. So we will be comparing 100,000 on our left to 105,000. That means goodwill will be equal to 5,000. Okay, so that's our at acquisition. We then need to account for since. Okay, so we have since retained earnings that we need to account for. And we also have since asset replacement reserve that we need to account for. We'll have a look at the calculation of that now. We then need to account for our current year. So our current year profits or loss and our current year transfer to reserve. Okay, which we can see happened in S. We did have a 3,000 transfer. Okay, so those will be the journal entries that we would be processing if we were asked to do pro forma journal entries. Okay, let's carry on down and let's have a look at the actual analysis of equity. Okay, so we had a look at our analysis of equity through our first journal entry so we could get the 5,000 goodwill. Okay, our profit, we've only had profit during the current year. Okay, there's our profit because retained earnings was 10 and retained earnings was 10. So that means we haven't increased our retained earnings, but we do have profit for the current year of 15 minus the tax of 3, so 12. Okay, so that's where we've got the 12 from. We have made a transfer to our asset replacement reserve of 3. Okay, so that's where we've got the 3 from. Okay, so we can see in terms of our since retained earnings that we have earned 12,000. Okay, times our 60% is 7,200. We have transferred 3,000 out of the retained earnings, so by 60%, that is 1,800. Okay, in terms of our profits, once again, it's just simply our H plus S. Our equity holders of parents are attributable to whatever H's profits were. So H's profits were 35 minus 9. That's 26. plus their portion, which we've calculated at the top there of S, 7,200. So that's how we got to that 33,200. Okay, our non-controlling interests will get their portion of their subsidiary, okay, which is the 12,000 subsidiary profit multiplied by the 40% holding. That's how we get to the 4.8. Okay, the statement of changes in equity. The new thing you're going to be seeing in here is now we also have a dividend coming through. Okay, that dividend we will see when we look at chapter 7. This dividend here, 5, is only H. Okay, so let me highlight that. We will discuss why it's only H in chapter 7. Okay, so that is H dividend only. Okay, the transfer to asset replacement reserve we have discussed. Okay, that's the 60% of the 1/8. Okay, that should be in line with that. That's misaligned there, so the 1/8 should actually be down there so that it's in line with the other 1/8. Okay, the comprehensive income for the year, this is from our income statement, the 33,200, there's the 33,200 there. The 4,800 here is the 4,800 here. In terms of the statement of financial position, once again, it's just H plus S plus our adjustments. So we had 20,000 revaluation of land there. Okay, we had the goodwill that we calculated on acquisition of 5. And you can do your checks. This is H plus their share of S. H again plus their share of S. Okay, and then the end product method you can go and have a look at, but it's just, again, it's explaining and going through each line item, how they did the calculations, so that you can show you're working in one line item as opposed to using your analysis of equity, or as opposed to using your pro forma journal entries. Okay, example 6.6. This is one that I'm going to want you to go through on your own, but I'm just going to highlight here quickly. Unlike in example 6.5, there's our retained earnings was 10. Retained earnings now is 16. So we have had an increase of 6. Okay, we do have our profit before tax here in here, and our tax, and our dividends. Okay, so that means that that retained earnings is opening balance. Okay, so from 10 to 16, we have made a profit of 6 that we need to account for. We then need to account for current year profit. It was 20, our asset replacement reserve, it's now 25. That is after having accounted for a transfer of 2. Okay, so before the transfer of 2, it was obviously 23. So we need to then take that into account. Okay, so your analysis of equity, there you can see that your subsidiary now, unlike in the solution previously, we have included our subtotals because of the fact that our reserves have increased through that time. It wasn't just a current year adjustment. We did have a increase in prior years that we need to account for. Okay, so I encourage you, go through, have a look, see that you can calculate these. Don't just go through and have a look at the question and say, I can see where in the solution it comes. Rather go and redo some of these examples before you do your homework so that you can get an idea of the process that has been gone through to be able to arrive at these statements. Okay, so you've got all your consolidated statements there. Here you do have your pro forma journal entries, okay, for your calculation of goodwill that we had a look at before of the 5. We can see that we have done our asset replacement reserve movements, and we've done our current year movements. So that's our since movements there. We've done our current year movements. Okay, this profit before tax and sale of land, this transaction is beyond the scope of accounts 212. So once your land has been revalued, we will not be telling you that we've all of a sudden sold it now. Okay, so you can ignore that pro forma journal entry. You will not be needing to do that, but please understand, how did we get our at acquisition journal entry? How did we get our since asset replacement reserve, our since retained earnings? How did we get our current year profits? And how did we get our current year transfer to the asset replacement reserve? Okay, and then there's our end product method. And that is the end of chapter 6. Okay, so it is quite a comprehensive chapter. There's quite a lot to go through, but if you're understanding the principle and understanding that equity will increase, there will be changes in equity once you have purchased your subsidiary. Some of them are for the current year, and some of them belong to a prior year. As long as we understand that concept, we can then be able to start and do the consolidation by accounting for our prior year movements and accounting for our current year movement. Okay, and chapter 7, which is the last chapter that we are going to be having a look at for accounts 2, we will be having a look at our intercompany transactions, and we're going to be seeing that there are a few more adjustments that need to take place, because when we're consolidating, we cannot have a loan to our consolidated self. We cannot say that we are charging ourselves interest. We cannot say we have paid ourselves a dividend. Okay, so we will be having a look at those transactions. Please note that our chapter 7 is limited to what is in the slides. So chapter 7 is very long in the textbook and it has lots of different transactions. We will be focusing on only the ones that are in the slides up to and including 7.1. Okay, so we will return to the next video and have a look at intercompany transactions to conclude our group activities.